Hey everyone, welcome back to StockMaven, your daily source of news and insights on the world of finance and investing. Today we're going to talk about how to set stop-loss orders on Webull, a popular commission-free trading platform that allows you to trade stocks, options, and cryptocurrencies. First of all, what is a stop-loss order and why do you need it? A stop-loss order is an instruction you give to your broker to sell a stock or other security when it reaches a certain price level. It's a risk management tool that helps you limit your losses and protect your gains. For example, if you bought a stock at $50 and you set a stop-loss order at $45, your broker will automatically sell the stock if it drops to or below $45, thus limiting your potential loss to $5 per share. Now, let's see how to set a stop-loss order on Webull. First, log into your account and select the stock you want to trade. Then, click on the trade button and choose buy or sell depending on your position. Next, select advanced order and then stop loss from the order types available. At this point, you will see a form where you can enter the details of your stop loss order. First, you need to specify the trigger price, which is the price level at which you want the order to be activated. You can choose between a stop loss order and a stop limit order. A stop loss order will be executed at the next available price after the trigger price is reached, regardless of the price level. A stop limit order will be executed at the trigger price or better, but not worse than the limit price you set. In other words, a stop limit order gives you more control over the price you get, but it also carries the risk of not being executed if the stock price drops too fast. Once you have chosen your order type, you need to specify the quantity of shares you want to trade and the duration of the order. You can choose between a day order, which will expire at the end of the trading day, or a good till cancelled order, which will remain active until you cancel it or it gets executed. Note that some securities, such as options, may have different order durations available. Finally, review the details of your order and click on Submit to place it. You will receive a confirmation message once your order has been executed or cancelled. For example, if there is a sudden market volatility or a trading halt, your stop-loss order may be executed at a worse price than the trigger price you set. Moreover, stop-loss orders do not protect you from other risks, such as fundamental factors that may affect the value of the stock you own. Therefore, it's important to use stop-loss orders wisely, and in combination with other risk management strategies, such as diversification, research, and portfolio rebalancing. Webull offers a variety of different types of stop-loss orders, including standard stop-loss orders, trailing stop orders, and stop-limit orders. Let's take a closer look at each of these types of orders and how they can be used to help manage risk in your portfolio. A standard stop-loss order is the most basic type of stop-loss order. When you place a standard stop-loss order with Webull, you specify a price at which you want the order to be triggered. Once the price of the security reaches that level, the order is triggered, and your shares will be sold at the prevailing market price. Trailing stop orders are a more advanced type of stop-loss order. With a trailing stop order, you set a percentage or dollar amount below the market price at which you want the order to be triggered. As the price of the security rises, the stop-loss order is adjusted accordingly, always maintaining the specified percentage or dollar amount below the market price. Stop-limit orders are similar to standard stop-loss orders, with one key difference. With a stop-limit order, you specify both a stop price and a limit price. If the security falls to the stop price, the order is triggered, and a limit order is placed to sell the shares at the specified limit price. This can be useful in volatile markets, as it allows you to control the price at which your shares are sold, rather than simply selling at the prevailing market price. It's important to note that stop-loss orders are not foolproof, and there are risks associated with their use. In some cases, the price of the security may fall sharply, triggering your stop-loss order and resulting in a significant loss. Additionally, if the market is particularly volatile, it's possible that your stop-loss order may not be executed at the price you specified, resulting in a larger loss than anticipated. One way to mitigate the risk of stop-loss orders being triggered by short-term price movements is to set a wider stop-loss percentage or dollar amount. This can provide more room for the asset to fluctuate before triggering the order. Traders can also consider using a trailing stop-loss, which adjusts the order price as the asset price moves in their favor, potentially allowing for greater gains while still limiting losses. In summary, setting a stop-loss order can be an effective tool for managing risk in trading, but it is not a guaranteed protection against losses. It is important to understand the risks and limitations of stop-loss orders and to use them in combination with other risk management strategies. Regular monitoring and adjustment of stop-loss orders is crucial to ensure they remain effective in changing market conditions. That's it for today's video on how to set stop-loss orders on Webull. I hope you found this information useful and informative.